Get Rich Slow with John Wolf. Hey, today, for the first time in quite a while, I want to make some commentary on what is going on in the mortgage-backed security market, what we can be possibly looking forward to, and just explaining some of the stuff you might have heard in the news very recently. So first, I want to show you a graph of what the mortgage-backed securities, which is what is really behind the base of what interest rates are, in the same kind of way as the price of crude oil affects gasoline prices. And that is to say, it's the cost of the real raw material, but there are marketing, transit, risk, cost of doing business, other expenses on top of that. But it's still what the base is. So just like how crude oil is the base for what you pay a gas in the pump, but there are taxes and all sorts of other things that make it more expensive per gallon, of course. Mortgage-backed security are the base of where mortgage prices come from. So here I want to just show you this chart. It's really starting February this year, and then the fear of economic problems and the stock market shooting down is actually why you see this chart shoot up to this caret that I'm pointing at now. And then after that, the worries about the economy actually got so bad that while bonds are a safer place than stocks, so you see the up, by the way, means the bond prices are going up. But when the bond prices go up, interest rates go down. It's an inverse correlation. But anyways, then all of a sudden, the people buying bonds, because they were safer than stocks, said like, oh my gosh, who's gonna buy these bonds from us if things get bad enough? And are these bonds really gonna get repaid, really? Even though they're very guaranteed by the federal government and such. But anyways, that happened. So then the price of bonds just fell precipitously. And you can see that, you know, red and down is bad. And the reason when you see this, like the thick candle, you see that it has a wick on both ends, the thick candle means though that is the area at which trades were actually happening in a significant quantity, and the tails are where buy-sell orders were made, but either not fulfilled or there was only very few of those buy-sell orders fulfilled at the extreme ends of those little tails. And then basically what you see is it just shoots back up, and that is not natural. That was not individual, human investors and citizens deciding like, hey, I actually like those mortgage-backed securities. No, what happened was the Federal Reserve basically, did and said they were going to just start buying every mortgage-backed security they could possibly write, and they were going to do that for a significant amount of time. They're still doing that. And the point is, this is actually the real stimulus plan for the middle class, because anybody out there who has like a $300,000 to $500,000 mortgage right now and still has their job and hasn't missed any bills to like completely screw up their credit, there's a really good chance that if they got their mortgage anytime in the last 7 years before we hit March, that they could refinance, and the refinance is probably going to look something like they're going to have $4,000 to $10,000 cash in hand all of a sudden, and then when their payment starts up, it's going to be $100 to $300 to $500 a month less. Sounds like a good deal, right? Well, it is for most people. But anyways, that's why this is the real stimulus plan, the Federal Reserve holding this up. And then two things are happening at once in this graph, because you can see after the bad time just gets past, it's just very slowly floating up. And that's actually the confidence of some normal investors coming in with the Federal Reserve. And then I'm just going to fast forward this to the very recent past, maybe not quite that recent, just so you can get a better perspective. So I'm just starting this in July. And then right here on August 11th, what happened is that not the Federal Reserve, but the consortium between Fannie Mae and Freddie Mac, which makes rules about mortgages and is controlling some of those back-end insurance costs, the things that are between the mortgage-backed security price and the actual home loan price. They announced that on the 1st of September, and they announced this on the, I believe, 12th of August. They announced that they were going to require 0.5% charge on every refinance. They called it an adverse market condition. And basically that was just saying like they want a ton more money. This was kind of crazy because the refinances that are happening right now aren't actually particularly very high risk, and they are making an insane amount of money right now. But anyways, they just announced that to be the first, and that was everything delivered on the first, which actually means loans that were even closing the day of the announcement are probably going to have to pay that fee, and it's not going to be the consumer directly paying the fee. It's going to, of course, be the mortgage company paying the fee, but it has to get paid. So basically what happened is 60 days-ish worth of business going into the future that has already been quoted out, loans already in process, the mortgage companies were going to have to take a very large haircut on. And so, of course, right after that, they were wanting to raise their rates. And partially because of that, but also just because basically every time there's a big piece of financial news, especially if it sounds at all bad, especially if it's directly related to these mortgage-backed securities, the bond price nosedives, which has the effect of increasing the interest rates. But you notice it's already kind of coming back, and really this is stabilization. So this isn't really a ton of movement, but things went from everything looking up to oh my gosh, just like a little oh my gosh. So that's why if you've been looking around, especially if you got quotes in the beginning of August, like August 10th or whatever, there might be a really good reason to look around again or ask your lender again where they stand on your rate, or even maybe look at a new lender, or at least say hi. Because if you were forced to lock in right after this price change, then it was probably not a great deal. Now, on my part, that actually happened for a few of the loans I was doing that I just, timing wise, everything was getting better, so I didn't lock the loan ahead of time, and then this happened. We just ate a bunch of the cost ourselves and gave the client what we had originally promised, but that sucks. And I know a lot of lenders don't do that for their clients. But anyways, that's what's going on there. So in the recent past, there was a rule change. Now already there was an announcement because there was enough complaining, and rightfully so, about this change. I believe it has been pushed back to December 1st. So that you will start seeing that quoted in mortgage pricing now, probably coming October, because most companies are taking about 90 days plus to deliver loans for refinances compared to when they quoted them. So that's what we're going to be seeing there. Let's talk about the future a little bit. So you might be aware that there's probably going to be a presidential election coming here in November. And I was just talking to somebody about that, and they said, well, there's only two options. Either Trump is going to win or Biden's going to win. And I said, well, really, there's more than two options. And the last one isn't great. And a lot of people are worried that it's going to happen, but the likely situations are Biden clearly wins, Trump clearly wins, or, and this is kind of the scary one, no one really clearly wins. And I will say, taking absolutely no sides, anything close, like a close victory on either side, is not a clear win, and it might cause some unrest, some uncertainty, which won't be great for the financial system. But what I will say is the predictions that the big investment houses, the smart money, the people who manage trillions of dollars, as far as what's going to happen if Trump retains office or if Biden retains office, and the simple answer and how that will affect mortgage rates, and the simple answer about that is that both parties, not political parties, but the parties, the big investment houses and the big mortgage houses, they think that the same thing that happened the last time a guy named Biden was vice president will happen when he's president, and the same thing when a guy named Trump became president, stays president. They think that'll happen again, and that is basically to say when Biden Obama gained the presidency, America was in a significant recession depression, and that recession depression lasted for the entire time that Biden was the vice president. And then when he left vice president, there was a giant economic upsurge when a guy named Trump got in the White House. So the actual prediction is if a guy named Trump remains in the White House, then because we're now in a significant economic depression, recession, there will be a massive economic expansion. Whereas if Biden, a guy named Biden, gets in the White House again, they expect the same thing to happen as last time, which would be things don't really get worse, but they absolutely don't get better for the vast majority of Americans. And I have no idea what will happen in either case, really. But those are sort of predictions, and they're at least supported by what happened in the past, which I guess is all we really have, because assuming that things happened in the past will happen again is a better strategy than just making things up entirely, I guess. But anyways, the way that'll affect mortgage rates is either way, the Federal Reserve has basically promised they're going to keep mortgage rates really low through the end of the year. So that probably won't be a change. But if there's a giant economic expansion after the election is decided, then you should expect interest rates to go up because they naturally would. That's why during almost all of the Trump administration's time, interest rates were going up significantly after basically being on the floor for the entirety of the last administration until the China trade war thing started. And there's a bunch that we could talk about that, but that was sort of an external artificial source. And then if there is a prolonged economic recession, we should expect interest rates to basically stay where they are now or go down a little. If things get really bad, they might go down more, but I'm certainly not hoping that there's massive, terrible unemployment and bad things like that. So anyways, if you thought this was interesting, if you want to comment, please nothing unkind to anybody. And again, this is just what I'm hearing from my financial sources. Please leave comments, smash that like button if you like it. If you dislike it, smash the dislike button twice, and subscribe if you think this is valuable, if you'd like to promote my channel and hear from me in the future. Anyways, have an awesome day. Bye.